Today is March 6th, 2026, and the market is showing clear signs of tension and uncertainty. The latest jobs report came in weaker than analysts had anticipated. This news adds a layer of complexity to the economic picture. At the same time, the price of oil has surged, climbing above the significant $90 per barrel mark. This jump in energy costs fuels concerns about rising inflation. As a result, market volatility, measured by the VIX index, has ticked noticeably higher. Traders are not taking on excessive risk. They are positioning themselves carefully ahead of two major upcoming events that could move the entire market. Traders now have their eyes firmly fixed on the calendar. The next major economic data point is the Consumer Price Index, scheduled for release on March 11th. This report will provide critical insight into the state of inflation. It will heavily influence the Federal Reserve's next move. Shortly after that, the Federal Open Market Committee will hold its policy meeting on March 17th and 18th. Their decision on interest rates will set the tone for the market for weeks to come. These looming events create a holding pattern, as large institutions pause before committing significant capital. The major market indexes reflect this cautious sentiment. At the close of trading, the SPDR S&P 500 ETF is hovering around 672.38. The Invesco QQQ Trust, which tracks the Nasdaq 100, is near 599.75. The SPDR Dow Jones Industrial Average ETF is trading at about 475.23. The most telling indicator is the VIX, which has risen, signaling an increase in fear and the expected range of market movement. Understanding these simple facts is not just background noise. These facts are the very foundation upon which sound, practical trading decisions are built for the days ahead. This environment requires a specific mindset. It is not a time for aggressive, speculative bets. Instead, it is a time for careful observation and disciplined execution. The market is providing clear signals about its anxieties. The weak jobs data suggests potential economic slowing. The spike in oil points toward persistent inflationary pressures. The upcoming CPI and Fed meeting represent known catalysts for volatility. A successful trader does not ignore these signals. A successful trader uses them to build a clear, logical, and risk-managed plan for every single trade they consider taking. To trade effectively in today's market, you must understand the primary forces that are causing prices to move. These are not complex theories, but practical realities. Macro policy, economic data, volatility, headlines, event-driven catalysts. The first and most dominant force right now is macroeconomic policy, specifically from the Federal Reserve. The Fed's target interest rate range currently sits at 3.50% to 3.75%. Every word from the Fed chairman and every new policy decision sends ripples through all asset classes. The upcoming meeting in mid-March is the single most important event on the horizon. Traders are trying to predict whether the Fed will signal a pause, a hike, a cut, and this prediction is driving short-term behavior. The second force is economic data. Today, the non-farm payrolls report showed a surprising loss of 92,000 jobs, pushing the unemployment rate up to 4.4%. This piece of data immediately changes the conversation from an overheating economy to one that might be weakening. The next critical data point is the CPI report. If it shows inflation is still high, the Fed will be in a difficult position. If it shows inflation is cooling, the market may rally. The third force is the interplay between volatility and news headlines. Volatility is not just a number, it is a measure of fear. When the VIX is elevated, as it is now, it means traders are paying more for protection through options. Sudden news, like the unexpected jump in oil prices, can cause rapid price swings. This is because algorithms and human traders react instantly to headlines that affect the inflation and growth outlook. In a high volatility environment, moves can be exaggerated. A small piece of negative news can cause a much larger drop than it would in a calm market. The fourth force is event-driven catalysts for individual stocks. While the macro picture dominates, company-specific news still matters. A key example is Oracle, which is scheduled to report its earnings on March 10th. A strong or weak report from a major company like Oracle can move not only its own stock, but also sentiment for its entire sector. This is a micro-level event happening within the larger macro storm. A skilled trader learns to weigh these four forces. They ask, is the macro trend so strong that it will overwhelm a good earnings report? Or is the company's news unique enough to defy the broader market? Before you even think about buying a specific stock, you must first develop a habit of reading the overall market structure. Think of the major indexes and individual stocks as two different layers of the market. The indexes, like the S&P 500, tell you about broad sentiment and the flow of big money. An individual stock has its own story, based on its earnings, products, and management. However, on a day with significant macroeconomic news, the broad market tide can easily overwhelm a single stock story. A great company can still see its stock fall if the entire market is selling off in a panic. A key concept to master is recognizing risk-on versus risk-off behavior. During a risk-on period, traders are optimistic. They buy assets associated with growth, like technology stocks, cryptocurrencies. During a risk-off period, like the one we are experiencing now, traders become fearful. They sell their riskier assets and move capital into safer havens, such as government bonds, gold, utilities, consumer staples. Watching this flow of money is crucial. It tells you whether the market's dominant mood is one of greed or one of fear, which helps you align your trades with the prevailing current. Another critical part of reading market structure is watching for sector rotation. For instance, with oil prices jumping, the energy sector might be strong. At the same time, with fears of higher interest rates, the technology sector might be weak. Observing which sectors are leading and which are lagging provides valuable clues about where institutional money is flowing. These patterns are far more reliable than just looking at one stock in isolation. Therefore, you must always begin your day by reading the major ETFs first. Look at a chart of SPY for the broad market, QQQ for technology and growth stocks, DIA for established industrial companies. Then, look at the VIX to understand the level of fear. Before making any trade, ask yourself three simple questions. First, is the tech-heavy QQQ weaker or stronger than the broader SPY? Second, is the VIX rising as prices are falling, confirming fear? Third, are we in a clear directional trend, or are we just seeing a chaotic panic flush? On March 6th, the answers pointed to a clear risk-off bias with tech underperformance. This analysis should always come first. Good trading is not about finding a magic formula. It's about consistently identifying and executing a few high-probability setups with strict rules. Your goal is to find patterns that repeat and offer a clear edge. Here are three practical, repeatable stock setups you can start looking for right now. The key is to define your entry point, your stop-loss level, your profit target before you ever place the trade. The first setup is trend continuation. Identify a stock already moving in a clear direction, up, down, and join the move. You're not trying to pick the top or the bottom. Trade with the existing momentum. For an uptrend, enter as price makes a new high, or after a brief pause. Place your stop loss just below a recent swing low. The second setup is pullback to support. Enter when price touches support and shows signs of holding. The third setup is breakdown through support. In a weak or volatile market, support often fails. Enter a short on the decisive break. In today's nervous market, failed bounces and breakdowns can provide clear opportunities. Options should be viewed as precise tools for managing risk, not as lottery tickets for getting rich quick. Next, anchor your day with a consistent routine. To use them effectively, you must understand the basics. A call option gives you the right to buy a stock at a certain price. A put option gives you the right to sell. You must be aware of the option's expiration date, as its value decays over time, a concept known as theta. Most importantly, in today's market, you must understand implied volatility, IV. Right now, with CPI ahead and the Fed meeting ahead, IV is high. This means options are expensive, and buying them outright can be a losing proposition unless you get a very large move. Given that implied volatility is high, You must match your option strategy to the current conditions. Blindly buying calls or puts is costly. Here are 5 practical strategies that are well suited for the market of March 6, 2026. The first is the simple long put. You would use this if your analysis strongly suggests the market is about to move lower, and you expect volatility to increase even more. This is a purely directional bet on downside. It is risky due to the high premium cost, so it should be used sparingly and with a clear invalidation level. A more prudent bearish strategy in this environment is the bear put spread. Here, you buy a put option at one strike price and simultaneously sell another put option at a lower strike price, both with the same expiration. This creates a defined risk trade. Your maximum loss is limited to the net cost of the spread. This is a superior strategy when IV is high because selling the lower strike put helps finance the cost of the put you are buying. It allows you to be bearish without paying the full, inflated price for a single long put. It caps your profit, but more importantly, it caps your risk. If you already own shares of a stock and believe it will trade sideways or have limited upside due to market uncertainty, the covered call is an excellent strategy. You sell a call option against your stock position, which generates immediate income, premium. If the stock stays below the strike price of the call you sold, you keep the premium and your shares. Similarly, if you want to buy a specific stock but think it might dip lower first, you can use a cash-secured put. You sell a put option at the price you'd be happy to own the stock. If the stock drops, you are assigned the shares at your desired price, and if it doesn't, you simply keep the premium you collected. Finally, a call debit spread can be used if you expect a rebound but want to limit your premium risk. Buy a lower strike call and sell a higher strike call in the same expiration to reduce cost and define risk. Success in trading is not the result of one brilliant decision. It is the product of a consistent, disciplined daily routine. First, before the market opens, check the overnight macro news. What happened in Asian markets? What happened in European markets? Did any new geopolitical headlines emerge? Second, mark the key economic events for the day and the week on your calendar. Know exactly when data like CPI is being released so you are not caught by surprise. Next, your analysis begins. Start with SPY, QQQ, DIA, VIX. Form a simple, one-sentence thesis for the day. For example, the market is in a risk-off mode ahead of CPI, with tech showing relative weakness. From there, build a small, manageable watch list of stocks that fit the current theme. Stocks breaking down, stocks holding support, stocks in strong sectors. Do not chase every stock that moves. Wait patiently for one of the clean setups you have mastered. When a valid setup appears, execute your plan with discipline. Use the correct position size. Never risk more than 0.5% to 1% of your trading capital on a single trade. Always enter your stop-loss order at the same time you enter the trade. Do not deviate from your predefined plan. After the close, review and journal. First, write a one-paragraph market summary for today, incorporating jobs, CPI, Fed, oil, and the VIX. Plan one stock trade and one options trade with thesis, entry, stop, target, size, event risk. Write a one-page personal risk plan. The final rule to remember is this. In this market, the macro picture comes first. Respect volatility. Use defined risk strategies. Trade a process, not a prediction.